Hi, this is Raghee Horner, and I wanted to do a quick video on the dollar Canada, specifically about the levels that it's reaching right now in terms of the range that we've been seeing. Now, when you take a look at the dollar Canada, one of the things that I think becomes very apparent is the fact that right now we're looking at a market that is testing its range. So consider that when you look at where the dollar Canada is right now. You can see the selling pressure that's come in here. You can see the selling pressure that's come in here before. Again, we're having a series of lower highs in this area. Okay, so as I consider what's happening, this squeeze that's going on, the squeeze between this lower high, and even arguably we have a series of higher lows coming in as well. What we can take away from this particular set of highs and lows, what's happening right now is really essentially a squeeze. Okay, so we're having a squeeze between what amounts to the 9,900 level. So consider where we've been finding the selling pressure. We have this 9,900 level, which is one to consider. We have the 9,800 level. All right, so here we are basically being squeezed by those two levels, 9,900 and 9,800. Now, go intraday. Let's take that next step. Let's go intraday. We'll see how slippery the slope is above 9,900. Now, breaking a major psychological level oftentimes can make traders think that there's going to be more buying momentum coming as the double zero is broken. So they'll expect that, hey, the double zero is broken as it is right now. You can see that right here. And they'll expect that prices will continue up higher. But in reality, take a look. We've been continually finding resistance above this level. And this is only about a 20 pip range here. Okay, so I want you to keep that in mind. Now, in terms of where or which time frame we can capitalize on what could be likely exhaustion before we get carried away, I want you to notice that the overall directional bias of the dollar Canada is doing what? I think there's a pretty good argument to be made here that the overall directional bias of this chart has changed. Not only do we have the green grab candles, but now we're looking at what is much more bullishness. So the green grab candles, and look at the 34 EMA wave heading up at that what we call a 12 to 2 o'clock angle. And if that 12 to 2 o'clock angle persists, we could actually consider this to be an uptrend. So I want to keep in mind that I really don't want to position myself in a trade that is counter what seems to be the dominant psychology of the market. However, what we can do instead is go to a time frame, and preferably a shorter term time frame, that is in distribution, that is a market that is moving along with a what I call a lumpy bumpy 2 to 4 o'clock angled wave. And right now that time frame seems to be the 60-minute time frame. And what I want you to focus in on when you're looking at this kind of lumpy bumpy sideways slop that we see happening on the 60-minute chart, notice the area that I'm focusing in on, okay, is this area right here. Okay, notice how the wave just isn't taking on either a 12 to 2 o'clock angle or a 4 to 6 o'clock angle. It's just moving sideways. And if that's happening, there is no dominant psychology here. So when that happens, what I'm going to do is I'm going to go ahead and insert an oscillating indicator, stochastics. I keep it pretty slow, okay? I want a really slow period on this. So what essentially happens is that we have this nice slow stochastic, which is currently overbought. Now take a peek. We have a stochastic that's trading above the 80 level. And when I have that kind of 80 level overbought psychology coming in the market, I'm expecting selling pressure to come in. So I have one reason here to expect selling pressure. I have a number of reasons again that we've lost the buying momentum. Right? So I put those two together, and what I end up with is a fade, what we call a distribution fade. Now, when I have a distribution fade, what I want to remember is that this is always an aggro trade. Always. Okay, distribution fades are always aggressive. So a couple of rules when it comes to distribution fades, and let's talk about that real quick here. Distribution fades, first of all, I want you to remember what it is you're looking at. What I call the lumpy bumpy 2 to 4 o'clock wave angle. Okay, that's number one. They're always going to be aggro. Always. I don't want you to forget that either. We're looking at an overbought stochastic, and we're looking at selling pressure coming in just above the 9,900 level. In fact, we looked at it 9,900, so at 9,920. Okay? So then what do I want to keep in mind as far as this trade goes? I'll look to do what's called a fade. Okay? This is not a difficult thing. This is basically capitalizing on exhaustion coming around a particular resistance area, right? We see all these resistance in the past. The near-term resistance I'm talking about here is basically between about 9,900 and 9,920. Okay? That's where this slope gets slippery, and that's where I'll expect prices to re-enter the range. That's all we're looking for. There's no trend to reverse. In fact, there is no trending market here. Okay? It's a lack of a trend, and because we lack the organization, that's why I'll expect the trend basically to suck price action back up into it. Okay? And the confirmation is the stochastic indicator. All right? So that is the distribution fade on the 1 hour, little longer term time frame that I would like. 1 hour. Again, this could be a slight counter trend. Again, it's super aggro. All right? If we start to get any kind of buying momentum above 99.20, I'd probably want to be very cautious and likely exit the trade. Again, it's an aggressive trade. It's probably counter trend at this point. But we can't deny how difficult it's been for price action to really get any kind of legs above, and again, I'm going back to about the 18th, any kind of legs above 99.20 to even about 99.30, and that's the exhaustion that we're counting on. The stochastic is confirming it, and that is a distribution fade.